Hello analysts, and welcome to the 360 Huntington Fund's video series on equity valuations. In this video, I'll be showing you how to retrieve and input the income statement into your valuation model, as well as cover some basic concepts that you should be familiar with. Please keep in mind that additional information on importing the financial statements can be found within the course packet that is available to all registered analysts through Blackboard. Let's get started. So first off, you'll want to open up your valuation spreadsheet. Where we're going to be focusing on is the income statement and a little bit on the quarterly evaluation income statement as well. So where you'll obtain this information is from Morningstar.com or Bloomberg, depending on your familiarity. Morningstar is a little bit easier. Bloomberg is a bit more comprehensive and has a lot more data involved with it. So first off, we're going to be doing Middleby Corporation, which is the example in the spreadsheet that's already there. So you're going to go up to the top, you're going to enter in the ticker symbol. For this, it's going to be MIDD. Click on the stock, and it'll bring you to this website. You're going to be clicking on the financials section, and then it automatically brings you to the income statement. Now you're going to want to make sure that the report shows an ascending order. You're going to want to make sure that it's in millions per share data, and it's the annual statements. So from here, you can click on the export button, which will download an Excel file for you. You can open up that Excel file. It looks something like this. So you'll want to format it a little bit so that you can see all of the line items. Make sure that all the data is correct. You're not going to need this trailing 12-month data, so you can either hide it or get rid of it. It's easier to delete just so that you don't import it by accident. So now you can line that up with the financial statement, or excuse me, the valuation template that you have as well. You're going to make sure that the line items are the same, and if not, you're going to need to input the line items manually into the spreadsheet. So for this, I just like to check revenue, cost of goods, cost of revenue, gross profit, so on and so forth. Check this ahead of time, so it is identical to what I have here. So you're going to copy and paste this information. What I like to do starting out is all of the direct information that you have that's inputted into the financial statements, you want to get rid of. That's not a formula, so you can get rid of all of this information. Sales, general, administrative, other expenses, interest income, income tax expense. So you'll be left with the formulas that have remained consistent. And from here, you're going to have to copy and paste in the data. So let's do that. So we'll take the revenue from 2009 to 2013, input that, cost of revenue, import that here. Then I'll give you the gross profit. Now you can double check this information by looking at what you have here and what's in Morningstar. It may not be exactly the same due to rounding inconsistencies, but this is fine the way that it is. It's not going to cause a great deal of issue. From there you can get your sales, general, and administrative expenses. There's no other operating expenses. You could delete this if you so desired. It's not really a big deal. It just happens to be in there as part of the template. Like I said, this may not be exactly the same depending on what company you get. Not everybody's financial statements are exactly alike. So then going to pull interest expense. You can see this is total operating expenses. Now if you wanted to, you could add another line item in here that just added up all of these and then took that and subtracted it, gross profit minus the total operating expenses. But you can see it's exactly the same because there's nothing in the other operating expenses section. So then you can take the interest expense, paste that in here. There are two other operating expenses over here, so you're going to need to put those in as well. Then you're going to get the income before taxes, so you can see that's remaining consistent. And then you're going to have the provisions for income taxes. So that's your income tax expense. So you're going to paste that in here. And from there, you'll be able to discern what the income tax rate is. We'll go over that in just a second. So now if you scroll down a little bit further, you're going to be looking for the earnings per share as well as the weighted average shares outstanding data. So for here, you're going to want to make sure that it's in millions, like I said before. So you're going to get the diluted shares outstanding. You're going to copy that in, paste the data, and then from there you're pretty much done with this spreadsheet. You can actually close out of it if you want to, but you can keep it for reference if you like as well. So let's maximize this. So now you can see the revenue growth rates. Those have filled in. The tax rate has filled in. There's an average growth rate here. So now that you have your diluted shares outstanding, you can get your diluted earnings per share. But before we get into this a little bit more, I'd just like to cover a few basic concepts with you while we're here. So first and foremost, let's look at the cost of goods sold. It's also referred to as the cost of sales, and it's the direct costs attributable to the production of goods sold by a particular company. The amount includes the cost of materials used in creating the goods, along with the direct labor costs used to produce it. It excludes indirect expenses such as distribution costs and sales force costs. Those come in later. And it's deducted from the revenue to calculate the company's gross profit. A little bit further down, you'll see the sales, general, and administrative expense, which is the sum of all direct and indirect costs related to selling, general, and administrative expenses of a company. Direct selling expenses are things like credit, warranty, and advertising expenses that can be linked specifically to a particular unit. Indirect selling expenses are not directly linked to the sale of a specific unit, but are proportionally allocated to all units sold during a certain period, such as telephone or interest and postal charges. And then the general and administrative expenses include the salaries of non-sales personnel, rent, heat, lights, that sort of thing. There's other operating expenses in here, but I mean there aren't any for this particular company. But that's really any other operating expenses directly related to the operations of the company itself. A little further down, you'll see interest expense, which is the cost incurred by a business for borrowed funds. It's a non-operating expense and represents interest payable on any type of debt like bonds, loans, convertible debt, or lines of credit. It's essentially the interest rate times the outstanding principal amount of the debt. Interest expense on the income statement represents it's the interest accrued during the period covered by the financial statements, but not the amount of interest actually paid over that particular period. If you go down a little bit further, there's the other income expense. Now that's related to non-operating expenses that could consist of deferred financing amortization, foreign exchange gains and losses, as well as other income or expenses unrelated to the direct income from operations. Income tax expense is pretty self-explanatory. It's the taxes that are paid on the income. The interest is tax deductible. So it's anything. It's the income for the company less the interest, as well as general operating expenses. So with this figure, you can figure out the tax rate. You can even drag this over if you want to look at how the tax rate has changed over time. I mean, companies are constantly trying to reduce their tax expense. so it can vary from year to year. For the forecast, you're going to want to use the previous year's interest or income tax rate, assuming it hasn't changed very much. You can find out some more information if you look through the 10K or the annual report of a particular company. You can find out some information on that there as well. Now, with regard to the diluted shares outstanding as well as diluted earnings per share. So diluted earnings per share is a kind of like worst case scenario. It takes into account the impact of dilutive securities, which can reduce the earnings per share. So the diluted earnings per share is actually, so it's the net income minus the preferred dividend over the weighted average number of shares outstanding, and you subtract the impact of convertible securities, the impact of options, warrants, and other dilutive securities that are out there. And that, like I said, kind of gives you the worst case scenario. If these dilutive securities are exercised, it'll show you what the earnings per share are. It's pretty common practice to use this in the industry. Basic shares outstanding is not as comprehensive of a number. So with regard to equity valuations, you want to be a little more on the conservative side if you can. Take things with a grain of salt. Management tends to be a little bit more optimistic at times, so it can be, it should be taken with a grain of salt. So after all this is done, you're going to want to just do a little bit of formatting, make it look a little nicer. And then you can go over to the common form sales. Now the inputs that you're going to be bringing in here directly change the forecast figures that are over here, not the ones in particular that have formulas in them for subtracting the items above, but with regard to the percentage inputs relative to sales. So the common form sales is it's taking expenses as a percentage of sales and looking at, so if sales go up, so we've forecasted 17.8% sales growth for this coming year, 2015. So that sales growth is reflected here, and with the increased sales, there are expenses that will go along with it. So if you look, historically speaking, between 2010 to 2013, you can see that there's an average of roughly 60.6, but 2014 looks like it's going to be going up. So kind of assuming that, let's say, interest or expenses are going up or are anticipated to go up in the next year. So you want to be a little bit more conservative. You go with, say, 62%, for example. So that number is reflected here, but this number is derived from these two figures, whereas this figure itself, the cost of goods sold, is from this input over here. So this will directly change and manipulate the cost of goods sold for 2015. So let's just shrink this down for a second so everybody can see. All right, so we have 62% in here. Say you think it's going to be a little more, you can say 65%, or maybe you think it's going to be less, 60%. That's it manipulates the forecast data there. You want to go with something close to average, unless you believe that something is going to change. If the company is reducing their expenses or expenses are anticipated to increase, you want to take that into consideration here. Further down, you're going to be looking at the same thing for the SG&A, other operating expenses, the interest expense, and other income as well. So you can see that each one of these inputs has its own figure here that you'll have to change and manipulate based on what the assumed rate or percentage of sales is. So you can look at the common form, check out the different percentages here. You can look at the averages to determine what you think is appropriate here, and then make your input, which you'll have to justify if asked during your presentation. So I think I've covered pretty much everything that you need to know here. You can format this a little bit further if you want to go put it in accounting. Make it look nice for when you present it. Moving on to the quarterly evaluation. This pretty much everything that I just covered applies directly to the quarterly evaluation as well. You can take all the notes that we just discussed and apply them here. There's a few additional things over off to the right here, the sanity checks, so to speak. It's basically taking the sum of your quarterly revenue and your quarterly earnings per share and matching them against the annual. So you can look at the revenue as well as your earnings per share to make sure that those figures match up between your quarterly and annual income statement. Other than that, everything is pretty much the same. So you should be able to, again, directly attribute the notes that I had just given you with regard to the income statement to the quarterly evaluation as well. This concludes this section of the video where we've discussed the income statement. The following video will cover the balance sheet and as well as the cash flow statement.